Hi guys. Today we will analyze A.O.Smith stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a bad performer in the overall market. Also recent evolutions are not positive. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Strong support levels are around $52 and $47.50. Next strong support level is around $45 and $38. Strong resistance levels are around $61 and $66. Next strong resistance level is around $73. In the last month the stock has been trading between $51.90 and $62.30 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 1 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 6% per year, for last 5 years. We see that the average profit margin of the stock has been around 12% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 106% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for A.O.Smith Company: bad, average, and good. First scenario. A.O.Smith will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 4%. Future profit margin would be low, 12%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $36. Second scenario. A.O.Smith will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 12.5%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $44. Third scenario. A.O.Smith will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 13%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $52. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 3.18. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For A.O.Smith, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for A.O.Smith Company: bad, average, and good. First scenario. A.O.Smith will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 4%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $29. Second scenario. A.O.Smith will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 18. In this case, the fair value of the stock today would be $38. Third scenario. A.O.Smith will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 21. In this case, the fair value of the stock today would be $48. As you can see, today the stock is overvalued, $55, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 5 to 6% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower before it recovers. The company is a dividend aristocrat. I may consider buying the stock for the dividend when the stock drops below $50. Company's strengths. A.O.Smith is one of America's largest producers and sellers of residential and commercial water heaters and boilers, and related home and construction products in North America, China, Europe, and India. The company has a conservative business model, very high dividend growth backed by solid financials, and one of the healthiest balance sheets on the market. Company management cited inflation-related pricing impacts, exemplifying its ability to pass on costs to customers. Geographic revenue mix continues to improve, citing robust demand outside of North America. The company has a wide economic moat, especially after its acquisition of giant factories, which analysts see benefiting the company as growth in residential construction continues in the coming years. North America water treatment has the most upside, stemming from secular trends in safe drinking water. The company is a dividend aristocrat. It has raised its dividend for impressive 29 consecutive years. The stock currently has 2.01% dividend yield. The company continues to repurchase shares, which should provide a valuation buffer in the near term. The company's return on assets of 15%, return on equity of 28% and profit margin of 14% are amongst the best returns in the industry. Risks. Risks include a weaker recovery in Chinese demand, higher than expected raw material costs, a decrease in new construction or replacement demand in the U.S., and higher than expected costs, tied to capacity build-outs and new product promotions. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 5 to 6% on average per year. The earnings per share is expected to grow by 8% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.